Look at me. I want you to really listen to me right now because what we are going to talk about today is the difference between a traditional fixed-rate loan and a floating-rate loan. And if you are approaching retirement, or if you are already in retirement, this is not just some boring financial jargon. This is a choice that can either secure your future or completely wreck the financial freedom you have worked your entire life to build. Many of you are looking at your expenses, you are looking at your homes, you are looking at your retirement accounts, and you are trying to figure out how to manage your cash. Maybe you need to borrow money for a major home repair. Maybe you are looking at a line of credit, or maybe you are dealing with corporate bonds and investments within your portfolio that use these exact terms. And you hear this word, float. A floating rate loan, a variable loan, an adjustable rate loan. It sounds smooth, doesn't it? It sounds light. It sounds like it just glides along without a care in the world. But I am here to tell you that if you do not understand what a float really is, that floating loan can turn into a financial tidal wave that will wash away your peace of mind before you even know what hit you. Let's first understand what a traditional loan is, because you need a baseline. A traditional loan, most commonly a fixed-rate loan, is the ultimate financial protector of your security when you are on a fixed income. When you take out a traditional fixed loan, the interest rate is locked in. It is set in stone. If your rate is 5%, it is 5% today, it is 5% next month, and it is 5% 10 years from now. It does not matter what the Federal Reserve does. It does not matter what is happening with inflation. It does not matter what is happening in the global economy. Your payment is entirely predictable. You know exactly what is leaving your checking account every single month. That is what a traditional loan gives you: predictability, control, and absolute safety. But then a lender comes along. Or maybe you are looking at a financial product and they say, well, why don't you look at a floating rate loan? Right now, the initial interest rate on this floating loan is lower than the traditional fixed rate. And your eyes light up and you think, oh, Susie, I can save money every single month by taking the float. Stop right there. Do not you dare sign that paperwork until you understand exactly how a float works. A floating rate loan is a loan where the interest rate is tied to an index, a benchmark rate like the Secured Overnight Financing Rate, which we call SOFR, or the prime rate. It means your interest rate is not locked. It floats. It moves up and down based on the economic tides. If market interest rates go down, yes, your interest rate goes down and your monthly payment drops. But if market interest rates go up, your interest rate goes up and your monthly payment skyrockets. Month after month, year after year, those rates climb. Your floating rate goes from 4% to 5% to 7% to 9%. Suddenly, your monthly payment has increased by hundreds of dollars a month. But guess what hasn't increased? Your pension. Your savings haven't magically multiplied to cover the difference. In fact, if the markets are volatile, your retirement portfolio might actually be down at the exact same time your loan payment is going up. This is what I call a financial double whammy, and it is born out of fear and a lack of knowledge. The fear of missing out on a slightly lower initial rate drives people to take on massive, unmanageable risk. Fear is the #1 internal obstacle to wealth. When you act out of fear, or when you buy into a product because you are trying to find a shortcut, you lose control of your financial destiny. I want to speak directly to the question that is floating around in your head right now, but Susie, isn't there any benefit to a float? Why do these things even exist if they are so dangerous for retirees? They exist because they serve a purpose for specific types of borrowers and investors. In the corporate world, large companies take out floating rate loans all the time because their revenues often rise with inflation, so they have a natural hedge. And for investors, and listen to me closely here, because this might affect your investment portfolio, floating rate loans can actually be an asset class. If you invest in a floating rate fund, you're the one collecting the interest. When rates rise, the fund pays out more income to you. So, as an investment, a float can protect you from rising rates. But as a borrower, as the person who owes the money, a float places all the risk squarely on your shoulders. The bank is essentially saying to you, we don't want to take the risk that interest rates will go up, so we're going to pass that risk directly onto you. Second, if you currently hold any floating rate debt, whether it is an adjustable rate mortgage, a variable home equity line of credit, or a high-interest credit card, which is the ultimate, worst form of a floating rate loan. You need to make a plan to get out of it immediately. We live in a highly volatile economic world. Do not leave your financial survival up to chance. Look into refinancing that variable debt into a fixed-rate loan, or better yet, let's use the money you have saved to wipe that debt out completely. I want you to examine your cash cushion. You should have 3 to 5 years of living expenses sitting in a safe, liquid, high-yield savings account or certificates of deposit by the time you retire. If you have high-interest floating debt, use your cash strategies to pay it down aggressively. Get rid of the debt. My ultimate rule for retirement is simple. You should strive to own your home outright, with no mortgage, and be completely debt-free by the time you retire. When you have no debt, it doesn't matter if interest rates float, fly, or sink to the bottom of the ocean, because you don't owe anybody a single penny. You have worked too hard for too many decades to let a floating interest rate jeopardize your future. Be strong, be smart, and protect your peace of mind.